Where did the $5 trillion in pandemic stimulus money go in the United States? That's an interesting question.
What a danger. Well, it's such an interesting question. It borders on dangerous, right? Because so much of it, where did it go? It didn't go to where it was supposed to go. So much of it. I mean, this is the problem with, look, Ayn Rand said it very well in Atlas Shrugged, which is that the classic, which is that, got capitalism. And when capitalism finally evolves into what she called mutant capitalism, and that's where we are, and that's when capitalism becomes a destructive force, not a good force. Good. And this is this is where we were at with the 2008 and 9 financial crisis. And since then, it's only gotten worse. Because if you look at where $5 trillion of stimulus went, what was it, like 1.2 trillion of it? Even when they passed these bills in Congress, well, we're going to put $3,000 a month in every household's pocket for 6 months to take care of the American people. Okay, sounds good. Well, where's the other 3.8 trillion going to go? Oh, we're going to give that to the $1 trillion corporations who are already worth trillions. Oh, thanks a lot. Yeah. I mean, this is the problem, that capitalism has become completely corrupt and unfair for the balance in the societies. And okay, again, let's not talk about that from a political point of view. Let's talk about that from this economic point of view. Why do I care? I'm an individual household investor person guy, right, with a family to take care of. And you say, oh, there's inflation. Well, how can I be smart? Is there inflation? Hey, Mary, honey, is inflation? Oh, yeah, honey, I go shopping all the time, and there's a lot of inflation. If the prices are what? Okay, so we got inflation. Well, what does that mean? Well, that interest rates are going up. Okay, now I can give you some advice. Which is, I'm not giving you advice as a financial advisor. I can say to you, we have inflation, which means we have rising interest rates, which means we know bonds are going down, because bonds, the relationship between bonds and interest rates, this is very fundamental, is an inverse relationship. As the interest rates go up, the value of the bonds goes down. Simple thing. This is not investment advice. This is just what they teach you in Economics 101 in school. As interest rates go up, bonds go down. What does that tell you as an investor? Not to buy bonds. Hello, you don't want to buy bonds. Bonds go down. However, there's a conflict with that, because there's risk on and risk off. Bonds are risk off. The stock market itself will no longer be benefiting from the Fed's $80 billion average of monthly pump QE. Some people call it the Wall Street's monthly cocaine shot, right? To buy of the Fed buying. That has been removed. That is gone. Now that is gone, in a risk-off environment, you will not buy stocks. You will not buy NASDAQ growth tech stocks. You will buy bonds. So we got a conflict. One story says, in an economic environment of rising interest rates, you wouldn't want to buy bonds because they're going to go down in value, obviously. But on the other hand, we're in a risk-off environment, and that's where you do buy bonds. So we've got opposing forces, Alex. And I want to say, we've got opposing forces, and I want your thoughts on this. Because again, you're the successful derivatives trader on the show right now. And I wrote it earlier, I'm going to find it. Okay, we've got this conflict, and here I wrote it right here. Alex, we got a tug of war between inflationary forces and deflationary forces. Okay, we got rising rates, we got mortgage and housing rates going up, which means that we could have a housing crisis, which would drive housing prices down, and a credit crunch, which is extremely deflationary, not inflationary. Kathy Woods has gotten her butt beat by how her stocks have gotten pummeled, but she keeps harping on the deflationary scenario. Okay. How do we make heads or tails out of all of this? Do you have some thoughts about it? I think you're a lot smarter about this stuff than I am.
My thought on this is very clear. Just because the stock market's going up doesn't mean you're making money, because you got to follow inflation here. If a dollar could buy you this last year, but only it can buy you half of what you bought last year.
Yeah.
If your stock portfolio went up only 10%, that's not covering the increase. You see what I mean? So you might have $100,000 invested and you made $10,000. Well, if you were going to buy something, let's say for $100,000 last year, but it's going to cost $200,000 this year, you're 90,000 short. So the market is a nice way to make people feel all warm when they're invested in it. That's one thing, is when they cash out the chips and walk out the door and they say, well, wow, I remember when I invested, the price of this was pretty cheap, so I'm going to, go buy that. And don't forget, when people are selling their apartments now and they want to get back into the market, they're buying into the same market. So they might downscale a smaller house and say, well, okay, I had a house, it's worth 500,000. It's worth, I'm going to sell it for 500,000 because I made 200,000 on it. Now, if you're in a country that doesn't penalize you for selling houses and capital gains, good for you. So you make that $200,000 profit, you put it into the bank, but it's fighting inflation while it's at that. It's fighting inflation that has just risen over 8% in one quarter, okay? And another quarter, and another quarter. So you're behind the 8 ball on that money that you've cashed out. Another thing that a lot of these municipalities love to do is they don't want the price of your houses to go down. Oh, no. Why not? Very clear. Most houses in North America and Europe have private tax on that property. It's called property tax. Now, some of the European countries still haven't done that yet. But do the municipalities? Yeah, the municipalities love the property tax game, because you don't really own your house in North America. On paper, it'll say freehold. Yes, you're the freehold owner. That's you. But I'll guarantee you this: don't pay your property taxes for 1 year and see how long you actually own that house, because the municipality or the regional government has the ability to go in and say, didn't pay us taxes, he's in default of those taxes, and in that title deed, guaranteed, they can fire sell that house on you, or they can even take it.